Is now a good time to buy an investment property, or should you wait? In the next 10 minutes, what we're going to do is unpack that question, because I get asked it all the time. We're going to have a look at the things that you need to consider to decide if you need to make that decision to purchase right now. My name's David Thomas from Trilogy Funding, and I've spent the last nearly 20 years helping Australian property investors navigate their way through the purchase of their first investment property right through until their 10th. So I'm ideally placed to be able to answer these questions. The first thing you have to have a look at is what the current interest rates are doing and what the economic climate looks like at the moment. So as far as interest rates go for property investors, most investors are managing to secure an investment loan rate at about 5.3%, and they're managing to secure a self-managed super fund investment rate from about 6.3%. Now, these rates have come down to this point, but recently new information has come to light in regards to interest rates and what they are looking to do in the future. And we're starting to see that the plateau, if it's not now, it's not too far in the future. So that then makes everyone adjust their ideas about what they think they want to do. The next point is inflation. So inflation has come from record highs in COVID down to in the twos, which is in the bracket the RBA was looking for. But the most recent bit of data is that inflation, or underlying inflation, has started to bounce up a little bit. You think about this from your own personal circumstances. Since the start of the year, your coffee is more expensive, the service on your car is more expensive, and probably some of your home living expenses have become more expensive as well. I certainly know that my kids' school fees have gone up as well. So inflation, underlying inflation, is starting to really creep up as well. The last thing is, what are property prices doing? Now, due to a few recent changes with some government policies and first home buyers and the ripple effect of that, property prices are now starting to rise. And in some circumstances, they're starting to rise very quickly. So whilst your borrowing power has dropped since 2021 due to higher increased interest rates and higher increased living expenses, demand for property certainly hasn't tapered off. Neither has capital growth. What we're starting to see is demand hasn't disappeared, and in fact has stepped up in well-chosen pockets or areas where people want to live. So when you zoom out and have a look at the market overall, what you see is that the market didn't crash because of higher interest rates. Supply and demand is playing a factor, and demand is still quite strong, regardless of whatever the interest rate is that you've got to pay for a property. People still need a place to live, and we're not creating those places to live at a fast enough rate. Every investor wants to pick the perfect time to get in the market, but it's always been a trap. If you think back at any point in time in the last 30 years, give or take 18 to 2 year periods here and there, if you had bought at almost any time, you would have made some money over a 10, 15 or 20 year period. And that's what we're really talking about here. Quite often I hear property investors say, look, I'll get back into the market, or I'll buy another property when interest rates come down and the holding costs get better. Or I'll hear property investors say, look, I think the market's going to soften in the future, and therefore I'll just hold back until prices get a little bit cheaper. But what we usually experience is that these things don't ever occur. There's no trigger for people to get into the market. They just do it when they seem comfortable. So if you're waiting for the right time, if you're waiting for comfort to occur, I feel you might be waiting whilst the market moves straight past you. Now, just backtrack with me until 2020 or 2021. That was the ideal time in most people's eyes to buy property. Rates were super low and property prices were increasing exponentially over a very short period of time. A lot of people identify that and say, right, now's the time to get in. Rates are super low, growth's super high. Those people that got in then had missed the boat. Do you know when the people that made the most amount of profit were then? It was the people that bought 3 or 4 years earlier when rates were higher and confidence was lower. Those people were the ones that cashed in 2020 or 2021 and made the really big profits because they were buying them in a depressed market much earlier on when confidence was down and interest rates were a lot higher. So think about the cycles of things. If you're judging your purchase on low interest rates and the ability for properties to go up in value, you're never going to get the timing right. So now we've looked at what not to do, let's have a look at what smart property investors are doing year in, year out, and why that makes them so successful. So instead of them thinking, is this the right time to buy? They are thinking, is this the right property to buy? Is this the right area to buy in? Is this the right price for this area? And am I buying it in the right structure? Because time will fix everything else. So here's the list of what savvy investors are doing right now. They're being selective on their property purchases. They're looking for area, they're looking for fundamentals of growth, they're looking for infrastructure within that area, and they're looking for what they think is going to be long-term rental demand for that property. They're looking for quieter markets. They're not looking to compete with 25 other buyers at every open home. They're looking at areas or pockets whereby there is a lack of competition for the purchase, but there is going to be plenty of long-term demand for that property for a variety of reasons. Maybe it's price point, maybe it's property type, maybe it's location. They're looking very long-term rather than what's just in front of them today. They're also structuring their finances strategically and calmly in a composed manner. They're thinking about where they're going to extract equity from, whether they're going to put the property on interest only or principal and interest, what their lender selections look like, and they're looking at what their long-term goals are. They're looking at whether they need to be considering this property in a trust or their personal names or a self-managed super fund in order to meet their long-term goals. And lastly, they're focusing on both yield, cash flow, and capital growth in their equations. They understand that it's not always about capital growth. Sometimes part of the conversation is about yield. If a property has a good yield that helps it hold itself when rates are higher, you're more likely to hold it for longer and through more property cycles and make more profit out of that property overall. Very hard to make capital growth out of a property that you sold 5 years ago because it was too expensive to hold. So what are the key metrics you should be looking at before you consider your next investment property purchase? Let's get practical and run through a list of things that you need to touch on if you're going to move forward with purchasing in the next 6 months. The first thing you need to check on is your borrowing power. If you haven't had someone review your lending abilities in the last 6 months, you need to get that done. With the changes to interest rates, credit policy, and some of the individual lenders' policies that have changed, what you can borrow now is much greater or different from what you could have borrowed 6 months ago. So run your numbers and that'll help you get a budget to then start to identify properties and areas that are going to be ideal for your needs. The next one is a cash buffer. Having money in redraw, offset, or a line of credit that you can access to cover you for 3 to 6 months. Once you've got that buffer and that comfort in place, you can then leverage a little bit harder to secure the right property. You can also consider properties that others won't, things that need maybe a renovation, whereby you may not see any rent coming in for the next 3 months. If you've got cash on hand to cover you, you can look at these kind of properties and opportunities that others have to walk past. The next one, they're doing research on areas where the rental vacancy rate is less than 2%. If it's been less than 2% for the last 10 years, guess what? It's probably going to be less than 2% for the next 10 years, which means you have the ingredients of long-term rental increases, which in turn gives you long-term property price growth. The more people that want to live in that area, the more prices are likely to rise in the future. The last one is your lending horizon. Always think about what's going to happen with your portfolio and that property over an 8 to 10 year period. If we're always thinking long term, little dips up and down really don't matter. If you buy a property today and in 18 months it's worth slightly less than what you paid for it today, but you know it's long term, 8 to 10 year fundamentals are all intact and it will perform, then you can still be comfortable in your decision regarding that purchase. And the last is psychology and mindset. Investors that build real wealth aren't the ones that panic and sell their properties early. And they're not the ones that wait for the perfect conditions and the perfect timing to buy a property. They're just the ones who act decisively and have a plan of what they're trying to accomplish. And they'll stick to that plan and they'll action it regardless of market conditions because they understand over time what they're trying to achieve. I guess what I'm trying to say is, if you've done your market research, you've got your finance in place, and you know that the fundamentals of the property are what you're looking for, don't let fear hold you back. Stick to your plan, stick to your strategy, and complete your purchase. There's always going to be some reason not to invest. Interest rates, elections, political policy, wars, you name it, it exists. These things have been happening for the last 30 years. They will happen for the next 30 years, but it's probably not going to have a great bearing on the property that you're about to purchase in the next month or two. So the truth is with this is there is no universal answer. There is no total checklist that will get it perfect every time. But there is a list of fundamentals and things that you can check off. And if you're meeting all of those, then now is the right time to go. And it's always the right time to go, so long as you are doing your homework and making sure that you're going to be able to buy this investment property. It's going to do what you want it to do, and it's going to last for the next 8 to 10 years in your portfolio. But if there is something in your due diligence that you see that makes you feel that that area is not right, that the property is not right, or that your personal circumstances aren't right, then that's the time when you should be reassessing what it is you're trying to accomplish. Sometimes you can't see the wood for the trees with these types of things. And that's when having someone to bounce these ideas off becomes really valuable. So if you'd like to have a chat with me or one of my team and chat through your current situation and what it is you're trying to accomplish over the next 10 years, then reach out. We'll run through some numbers. You can use this as a bit of a sounding board for what it is you're trying to do, and then we can kind of structure things so they are going to help you in the future. As always, click on the link below to set a meeting in our calendars, subscribe to the channel, and like and share with someone else that this will benefit.